We're talking about partnerships. Partnerships are a very common business structure for particularly people in professional practices, but they can also be people who are operating smaller businesses, etc. You see a lot of legal firms, accounting firms, architecture firms, engineering firms, etc. that are established as a partnership. One of the things about a partnership, and we'll go through the structure of partnerships, we'll go through who the partners can be, we'll go through some issues with regard to liability in partnerships, and we'll just touch off on some basic tips and traps for people who are contemplating operating their structure through a partnership. So when we talk about a structure of a partnership, we talk about two people or two parties coming together, and together they will deal with the real world. It could be two, it could be three, it could be four, it could be five, it could be 20, it could be 500, it could be 1,000 coming together within this partnership model. Now, that partnership, they will each have a defined share of the partnership. It might be defined in the partnership agreement, which we always recommend people do, which says, okay, each partner has got a pro rata share of the partnership. So if you've got two partners, they might have 50% each. It can be that you have two partners, one has 60%, 40%, 70, 30, it doesn't really matter. It's all by agreement between the partners. So the partnership is this entity that deals with the external world, and there's a whole heap of people behind it, some of which you know, some of which you might not know. When it comes to the partners in a partnership, they can be individual people. It could be normal human beings. It can also be companies. So you could have a company as part of a partnership. You could have a trust as a partner in a partnership. So anything that, any normal business structure, a sole trader, individual person, a company or a trust can be a partner in a partnership. And that's where you can structure it differently depending on the needs and requirements of the people who are getting involved in the partnership. When we talk about liability for partnerships, because the thing is, partnerships, as I said, are easy to set up, but one of the problems you have is that you do have what's called joint and several liability. And this is where you see a lot of legal firms in particular get very antsy about what's going on, who's doing what the other partners are doing, because the other partners can actually create a situation where the liability that they create dealing with their customer flows back through to the other partners. And if the partner that created the problem can't pay to rectify the problem, the other partners have to. And so that's what they mean by joint and several liability. They're all in the bucket together when it comes to liability. So you need to be very careful when you're operating a partnership that you trust implicitly and absolutely your fellow partners, because if they do something wrong, you can end up wearing the can for it. When we talk about traps and tips and all that sort of stuff for partnerships, there's a couple of things, and these are really overview stuff here. There's a couple of things that we need to be conscious of. One is, if, say you're in a partnership and you want to get out of the partnership, there might be four of you together in a partnership and one of them wants to leave. Now, that can be an interesting exercise, and it needs to be well thought out and planned, because each partner has what's called a separate and discrete interest in every partnership asset. So if the partnership owns a desk, then let's say the four partners, each of those partners owns 25% of that desk. It can be very, very difficult to chop 25% of that desk off and send it off with the other partner. So in some respects, when you're setting up a partnership, you need to, as some of my lawyer friends say, to design the divorce before you get married, and that's where the partnership agreement comes in. So be very aware when you're transferring ownership, and transferring ownership can be somebody exiting, it can also be somebody entering the partnership. So that needs to be very carefully thought out. Another thing with regard to partnerships is that they operate under different tax rules to companies and trusts and individuals as well. There's specific things with regard to partnerships that you need to be aware of, and one of the good things about partnerships is if you've got a tax loss that the partnership has made, that can be distributed out, whereas other structures such as companies and trusts, they're held within that particular entity structure. So partnerships can be very flexible, particularly if you're making losses in a few years and you've got other entities that are making profits. It can be very, very flexible. That all needs to be planned out and considered fully before you decide to go down the partnership path. The other thing that you need to be aware of, and this is particularly particularly an issue where you get larger professional partnerships, is there's specific rules with regard, and I'm talking particularly tax here, there's specific rules that apply when you change partners when you've got more than 20 partners. So you need to be aware of that, and it can be a little bit confusing, but it can also be quite simple. I know this is sounding a little bit higgledy-piggledy, but the issue is you need to be very aware of how your change in partnership with, and it's even changes in interest in the partnership, how that all impacts and how that flows through. So partnerships are very flexible, they're very easy to set up, but they can also be very dangerous with regard to the liability issue.